Alright, you monsters, I mean children. Welcome back to AP Macroeconomics with your favorite teacher, me, Mr. Fritz. Today we're going to be talking about tax multipliers and government spending multipliers. So in the last video I taught you about the two tools of fiscal policy, government spending and government taxes. Now though, we're going to talk about how those tools have a multiplier effect throughout the economy. When the government spends $1, it doesn't only add $1 to the GDP. There's a multiplier effect through the rest of the economy. Every time somebody spends money in the economy, that turns into someone else's income, and then that person then has more income to go spend. For example, Mercedes spends $100 at my coffee shop. She just spent $100 at my coffee shop for some reason. That adds $100 to our GDP. Now I have $100. Let's say that I spend $50 out of that money that I just earned in income. So now I go and I spend $50 at Ivan's ice cream shop. So I'm spending $50 at Ivan's ice cream shop out of the $100 that I earned in income for Mercedes. The GDP has now increased by $150. Now Ivan's income has increased by $50. If he spends half of that, $25, at Steve's sandwich shop, now the GDP has increased by $175. And now Steve, the sandwich store owner, has money to go spend as well. So when money gets spent in the economy, each dollar spent doesn't just increase the GDP by $1. And that happens too when the government spends money. Rather than walking through all those steps every single time the government increases or decreases government spending or taxes, what we instead do is use the tax multiplier and the government spending multiplier. First, before we do that though, we need to talk about what our marginal propensity to consume and our marginal propensity to save are. Looking back at our example that I just used, Mercedes spending $100 at my store, my coffee shop, we're going to talk about what the marginal propensity to consume is and the marginal propensity to save is. What we need to do is we need to figure out on average about how much people are spending in the economy out of every increase in their disposable income. So this extra $100 that Mercedes spent at my store increased my disposable income by $100. To find out what my marginal propensity to consume is, or about how much money that people are spending out of each additional dollar in their disposable income, we would take our change in spending and divide it by our change in income. So in that original example there, my change in spending was $50. I went and spent $50 at the ice cream store. My change in income was the $100 that I earned off of Mercedes purchasing coffee from me. 50 divided by 100 comes out to 0.5. My marginal propensity to consume is 0.5. That means out of every dollar that I earn, every additional dollar in disposable income I earn, I'm going to spend about 50 cents. Now, what else am I going to do with that money? Well, I'm either going to spend my money, consume, or save my money, marginal propensity to save. So we can also figure out our MPS, the marginal propensity to save, or on average, how much people are saving out of each additional dollar in disposable income they're earning. So my change in savings, I spent $50, so I saved the other $50. My change in savings was $50. My change in income was the $100 that Mercedes spent at my store. So it's going to be 50 divided by 100, and that comes out to 0.5. Hooray! Alright, so what that is, my MPC is 0.5, my MPS is 0.5. Together they have to equal 1, because it's our marginal propensity to consume or save. Out of every additional dollar that I'm earning right now, I'm spending 50 cents and saving 50 cents. Now let's talk about the multipliers. To make this whole process a little bit simpler, we just use multipliers, basic multipliers. We have a tax multiplier and a spending multiplier. For the tax multiplier, your equation is the MPC over the MPS. For the spending multiplier, it's 1 divided by the MPS. Right here in this example, we have an output gap. We are in a recession. They have an $800 current output, $1,000 potential output. That means that they're $200 short of their potential. They're in a recession, and to get out of it, this government is going to have to get the real GDP to increase by $200. They're going to do that by cutting taxes and or increasing government spending. However, because there is a multiplier effect in people's spending, because one person's spending turns into another person's income, who then uses that income to go spend. Because of that situation, you can't just increase government spending by $200 or cut taxes by $200, because you'll have a multiplier effect and you'll end up over here in an inflationary gap. In that economy that we were talking about before, where I was going to get $100 worth of coffee, or no, I was going to get $50 worth of ice cream. The MPC, or marginal propensity to consume, is 0.5. That means that our marginal propensity to save has to be 0.5 as well, because together they have to equal 1, and because out of every dollar, they're spending 50 cents and saving 50 cents. So together they equal 1. Our spending multiplier is 1 over the MPS, so right now that's going to be 1 over 0.5. I like to think about this as money because it makes it easier for me to figure out the math. If you're good at math, then just ignore me. 50 cents goes in a dollar 2 times. So our spending multiplier right now is 2. That means that at every dollar that the government spends, it's going to multiply in the economy by 2. For a tax multiplier, it's MPC over MPS. Right now it's 0.5 over 0.5. 0.5 divided by 0.5, 50 cents goes into 50 cents 1 time. Our tax multiplier is 1. Our spending multiplier is 2. Now that we know how much these changes are going to be multiplied throughout the economy, we can figure out how much we need to spend or stop taxing. So because we need to get people to spend $200, we need to figure out what times 2 equals $200. Well, this one luckily is super easy. It's 100. So this economy, this government needs to spend $100. Disposable income in this economy is going to increase by $100, and then people will end up spending the other $100 to fill this gap. $200 will be spent, aggregate demand will increase and shift to the right, and we'll get out of this recession. Or they can instead figure out what times 1 equals $200. So if they want to do this with taxes, changing taxes, they're going to have to cut taxes by $200. Because right now, our tax multiplier is 1. So if you cut taxes by $200, the people or consumers will spend $200 and close this output gap. You may have noticed that our spending multiplier has a greater effect than our tax multiplier. That will always be the case. And that's because when the government spends money, government spending is part of this aggregate demand. Remember CIG and X. When the government spends money, the government went and spent $100. That immediately increased our GDP by $100. Then all the people that earned income off that $100 of government spending now have extra disposable income, and they're going to spend some and save some and continue adding to the GDP. However, when the government just cut taxes, they didn't spend anything. That initial cut in taxes did not change our GDP. It did not increase the GDP, and then people were spending some of their money and saving some of their money. And so because of that, the tax multiplier is always going to be smaller than the spending multiplier, and that's how it goes. So that was tax and spending multipliers. Next time, we're going to talk about how the government's budget affects the real interest rate. Goodbye, children.